What's up, guys? Welcome back to DCA. So every day on crypto YouTube, you hear people talking about the Fed, quantitative easing and tightening, interest rates, and most importantly, inflation. For those of you that don't know, I was an economics major. I'm now a physician, but I still have some of that knowledge rolling around there somewhere. So what I'm going to do today is talk to you about these factors and how they influence the cryptocurrency asset class. Because at the end of the day, quite frankly, you hear a lot of people talking about it that very likely don't know anything about it. They're basically just parroting words back to you that they've heard. So we're going to talk about these factors and how they influence the crypto market. We're going to do it in very simple and quick terms so that anyone can understand what it is and you can understand how it may affect you as an investor going forward. So with that said, let's do it. So we're going to start our discussion today around the idea of a central bank, or in the US, the Fed or Federal Reserve. We're going to discuss what the role of the Fed is and why you hear about it every day and how it relates to both the stock market and the cryptocurrency asset class. But we're going to focus on how it relates to crypto. What is the role of the Fed? And we're going to be focusing on the Fed specifically because that's commonly what you hear talked about every single day. So the Fed, what is their role? Their role in general, as it relates to what we're talking about today, is to step in the setting of a slowing economy and attempt to stimulate that economy through various monetary policies. So we're going to talk about a few of those today. Specifically, we want to dive into quantitative easing and quantitative tightening and what the effects of those policies are. So the first thing we're going to talk about is simply the Fed can control the interest rate. So when the Fed changes the interest rate, specifically in the setting of a slowing economy, the Fed will decrease the interest rate. Now, why would they do this? Decreasing the interest rate decreases the cost of borrowing money. When money is less costly to borrow, this, in theory, will lead to more spending in the economy. If you have ever went to buy a house, you have to strongly consider what your interest rate is when buying the house to determine whether you can afford to make the payments or not. The same thing goes with a car. The same thing goes with any type of loan, a business loan, for instance. So the Fed attempts to stimulate the economy via decreasing interest rates to the point where it becomes very cheap to borrow money. And hopefully that will lead to businesses and individuals borrowing money and spending in the economy. Now, what's the problem with that? Well, at the moment, interest rates are extraordinarily low. And in fact, if you look in Europe and places like Japan, certain places in Europe and Japan, you actually have low negative interest rates. So the Fed and central banks around the world are sort of over leveraged in that area. They can't drive interest rates down any lower than they already are. So when you've reached a situation where you've driven the interest rate down to approaching zero or even negative, you're sort of out of options with regards to interest rates. So you have to look to your next layer of policy. So the next thing we're going to talk about is actually quantitative easing. And this is what you hear about every single day on YouTube. People parroting back to you the words quantitative easing, inflation, interest rates. So what is quantitative easing? Well, in general, and simply put, it is the Fed crediting themselves money. So what do they do with this money that they create? They go out to banks and they buy Treasury bills and Treasury bonds, okay? So they give the banks money that they created, and in return, they get financial assets. In other words, in this case, we're talking about T-bills and T-bonds, all right? So now they have created money, added it to the money supply, and now the central bank is holding actual assets, okay? So they are increasing their own balance sheet. Here's how we're going to do it. We're going to look at what the central bank did and what the result in the economy was. So like we said, the central bank gave themselves money, created money, bought T-bills and T-bonds from the bank. In other words, bought financial assets and then gave the banks money. So this increases the money supply. So what is the purpose of the Fed doing this? Well, like we said, remember, we're talking about a setting of a slowing economy. And in the setting of a slowing economy or financial uncertainty or economic uncertainty, banks are typically not very willing to lend. So by buying treasury bills and bonds from the banks with money that was created by the Fed, they increase the money supply. So now the banks have more money just sitting in the bank, not doing anything. When the money is just sitting there, not doing anything, then if you would like to earn a return on that money, they will lend that money out to both businesses and consumers. Okay. So we have treasury bills and bonds bought by the Fed with money that they created. This increases the money supply and in hopes of stimulating the banks to lend. In addition to, simply incentivizing the banks to lend out the money, it also is in the hopes of decreasing interest rates further or decreasing borrowing rates. Because when banks, they're not just giving it all to one bank, they're giving it to many banks. So they're creating competition for that lending, which competition drives prices down. So they're hoping to A, increase the amount of lending, and B, decrease the cost of lending. So we said that the Fed or central banks go out and buy treasury bills or treasury bonds, okay? And the effect that this has is perhaps most related to the cryptocurrency asset class. So what this does, the way a treasury bill or bond works is it pays an income, okay, per year, and that is divided by the price. So the income that it pays you divided by the price equals the yield. All right. Now we know simply if you are buying something, if there's demand for a particular type of asset, what happens to the price? All right. And we know that prices go up when there's high demand. If the price of a treasury bill is going up, and we're going to use just very general terms here in order to, simplify what we're talking about. So let's say that you have a treasury bill that is paying you $3 per $100. So the cost is $100 and it's paying you $3 per maturation. Okay. This means that you have a income rate or a yield rate of 3%. All right. So every maturation period, it pays $3. Now let's suppose that the Fed starts buying T-bills. This is going to drive, as we said, it's going to drive the price of these bills up. So what will happen then? All right, so let's say it goes up to, just for simplicity, let's say it goes up to $110. So that's the cost now. Well, what was a 3% rate now becomes a 2.7% rate. All right. So, the reason that they do this then is because these are considered very low risk assets. These treasury bills and treasury bonds, these are considered low risk assets versus things like stocks and cryptocurrency, especially cryptocurrency. These are considered high risk assets. Okay. So when you're decreasing the yield of the low risk assets, okay, because these are government backed, so these are considered very safe, low risk assets. You're essentially, disincentivizing investing in this low risk asset and pushing the incentive into the higher risk assets because you're expecting higher returns from the, higher risk adjusted returns from the risk assets when you're driving the return or yield of these treasury bills and treasury bonds down. So this has a direct effect on cryptocurrency, this quantitative easing. Remember, what we're talking about right now is still quantitative easing. So you're causing businesses, institutions, whoever, individuals to not want to invest in these treasury bills and bonds. You're driving them into the riskier securities, and in this case, cryptocurrency. So this is just one type of asset the Fed can actually go out and buy, but it's not limited to this. They can increase this in times of financial uncertainty and actually go out themselves and buy risk assets. Okay. So this is the standard method that they use, in order to sort of control the money supply, but they can ramp up these efforts in the times of financial uncertainty and actually go out and buy the risk assets themselves. Now let's talk about the crypto YouTube meme number 3. So this is the one that you hear everyone talking about. It's the reason that you hear people talking about Bitcoin as the future of currencies. We're talking about inflation. So we're going to talk about what inflation is, why it's important, how the Fed is causing it, and an additional factor that you need to consider about inflation right now specifically that's very troubling. Inflation is, simply put, a drop in the value of your dollar's purchasing power. So if a soda cost you $1 10 years ago and it costs you $2 today, then you have lost purchasing power with your dollar. Okay, so in general, that's what inflation is in its most simple terms. The Fed has increased the money supply, recall, by buying various financial assets. They've increased the money supply. What has this done? This adds money into the economy. If that money added into the economy expands faster than the rate that the economy can match that level of demand, so there's an increased level of demand. If you have more money, if you have $1,000 today and that's all you have and you have to live on that for a month, well, you're going to be getting by on, fairly meager living circumstances. But if I give you $100,000 this month, then you're going to be living more lavishly. All right. You're going to have a higher demand for goods. But what if everyone has $100,000 now? What if I give every single person $100,000? Well, now everyone has a higher demand for goods, but it's essentially at a place where the money has increased for everyone. So the cost of goods across the entire economy will simply increase. So the rate at which the economy is producing the goods that are demanded by individuals will not be able to match the rate at which individuals are demanding those goods. Okay. The Fed puts this money into the economy. This leads to a situation where demand is outpacing production capability. When that happens, the price naturally has to increase. If demand, it's just like the price of an asset. Okay, so you have your demand and your supply. So let's think about it in terms of Bitcoin. If you have a demand for Bitcoin and this is rapidly increasing, but your supply is not changing, what's going to happen to the price of Bitcoin? The price is going to shoot up. All right. So what we see is the Fed increases the money supply by giving money to the banks who then go out and lend it. So the money supply has increased. This leads to an increased demand, but supply simply cannot match it. All right. And this brings us to our key point today. We all talk about the Fed, and that's, the more obvious circumstance. But really what you have going on now, COVID has shut down your global supply chains. What happens when your global supply chain gets shut down? Okay, so we have a twofold problem occurring at the same time. So demand has increased, all right? Demand is increased because the Fed has increased the money supply. Well, what has happened to supply? Supply has been cut off because of COVID. Manufacturing has absolutely been destroyed in the economy. So you have increased demand due to increased money supply, and in fact, just an unprecedented level of increase in money supply, as well as at the same time, your global supply chains have been cut off. So let's look at it in terms of numbers. So let's suppose, and we'll just put a number here. Let's suppose our baseline demand is 100. Okay, that's our baseline demand. And let's say our baseline supply is 100. Okay, so our economy is in equilibrium. The top number is 100, the bottom number is 100. And so we don't have inflation or deflation in this case. So now let's say that we increase the money supply by 50%, so our demand increases by 50%. So this number becomes 150, all right? So we're not at 100 anymore, now we're at 150, okay? And from there, COVID has happened, so we're not producing 100 anymore either. We're producing much less than we used to be. So supply becomes 50, okay? So we were at 100, 100 in an equilibrium point in our economy. Then our demand became 150, our supply became 50, and now you have runaway inflation because your demand is simply rapidly outpacing your supply. And this, guys, is the problem. This is the problem you're hearing about. Typically, you either have one or the other, or, varying degrees of one or the other. In this case, you have extremes of both. You have a shutdown in the global supply chain like you've never seen before. You have, the largest expansion of the money supply ever, and they're both occurring at the same time. So this is why you hear about runaway inflation. And, it's this simple. Increased demand, decreased supply leads to rapid inflation. The supply just cannot keep up with the increase in demand. So you're running into a situation where buying power is decreasing. Okay. So now that we have that, let's talk about how this ultimately affects crypto. And it's the dirty word that you hear every day now: quantitative tightening. So the Fed has this problem. They have an increased demand, caused by an increase in money supply that they created, as well as a decrease in supply that truthfully they couldn't really do anything about. You couldn't stop manufacturing shutdowns due to COVID. So you have, this double-sided problem. And what can the Fed do then? They can't do anything about the supply. They can't do anything about manufacturing in China. But what they can do is decrease the money supply. And this is what quantitative tightening is. They are going to get rid of those financial assets that they have put on their books. So recall, we said they had bought financial assets. They are going to now remove those. Okay, so they're going to decrease the financial assets that they've been putting on their books. This is then going to decrease the money supply. And by doing that, you're fighting the demand side of the curve. Like we said, there's nothing you can do about the supply side, but you're trying to push this 150 number back towards 100. They won't be able to get it all the way down to there, but they will try to decrease this number, down to, let's say, 125. Remember, these are just numbers, just to illustrate the point that 1/1, 3/1 is bigger than 1/1. Okay, so 150 divided by 50 is 3. We're just showing you that when the demand side and the supply side are happening at the same time, when the inflationary effects of the demand and supply side are happening at the same time, it's an exponential worsening of the problem than if you only had one of the issues. Okay, so they are going to try and drive down the demand side issue by decreasing the money supply, by removing the securities, by removing the treasury bills, by removing the treasury bonds from their books, decreasing the money supply, increasing the interest rates, decreasing the amount of borrowing in the economy. Okay, so they're trying to slow things down because as it stands, the inflation rate, or remember, the loss of purchasing power of your money, is out of control. So they are trying to limit the effects of inflation on the economy, and that's how they're doing it. So we're looking at Bitcoin US dollar here, and this is how it all ties in. This is the price times volume. In other words, the amount of dollars being traded in Bitcoin. And this shows you that, after COVID, after the Fed began quantitative easing policies, from its low point in July up until its peak, the amount of dollars being traded in Bitcoin actually increased by 2,400%. So there was just a rapid influx of money into the economy, into these risk assets, spurred on by, the Fed stimulating the economy and artificially stimulating the economy. So you had all this money in the economy. Remember, what was our issue? Our issue was twofold. We had a demand increase, a massive demand increase. So lots of people had lots of money, but there was nothing to buy. There was literally nothing to buy. So what are you going to do? People were investing it. You're investing into the stock market, you were investing into crypto or other risk on assets. So people were taking all of this money that they had created by the Fed, and there was simply nothing to buy. You couldn't go anywhere, you couldn't travel, you couldn't buy anything. For instance, if you were in the market for luxury cars, you could not find, you may have seen my video on I bought a McLaren prior to COVID. People were calling me to buy my car, simply they were calling me to buy my car for more than I paid for it, which is unheard of for a used vehicle, particularly a sports vehicle. So people were calling me to buy it for more than I paid for it because of the fact that you could not buy them anywhere. No one had cars. If you went to a used car lot during the worst stages of the COVID event, you couldn't buy a car. There was, if you've been in the market for computer chips, you still can't buy a computer chip. I posted on Twitter today. If you've watched the show, I wear white V-necks on the show every day. I went on to buy my white V-necks because I buy them every other month, and they're back ordered for 5 months. So there's just simply a global shutdown in terms of the supply. So that money has to go somewhere, and it was going into investment vehicles. And now you're seeing this policy being reverted, and this is leading to a situation where we're going to see, a lot of this free money that's been out there. It's going to start, being retracted from the economy. And I think you're going to see some, at least, people that are ignoring this are simply ignoring the facts of how quantitative tightening works. Okay. So this is what we're watching, guys. This is why, I try to remain bullish, but it's very difficult when you just simply look at the economics of the event. Not many people on YouTube are going to be looking at the actual economics of the situation that we're in. People are going to look at lines on charts and, their opinions, but we don't care about opinions here. We care about facts. That's it for this one, guys. If you guys like this type of content, hit like and subscribe. And until next time, as usual, see you.